The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I'm Diwakar Yadav, Product Manager, Mutual Fund Product Manager from HDFC Securities. And thank you, everyone, for joining this webinar. Finance Minister Nirmala Sitharaman presented her 7th state budget today. It was an important day there. There were many things which were there in the budget. And in today's webinar, we are going to learn about key important points and its impact on market and economy. After the session, we'll take some questions from the participants. And to discuss that, today we have Ms. Namrata Mittal with us. She is the Indian economist for SBI Fund Management. She is there since 2014. Prior to joining SBI Fund Management, she worked as a consultant in the Foreign Investment Promotion Board and Capital Market Division at Ministry of Finance, Government of India. She began her career as an economics associate at HSBC Global Resourcing, where she worked on economic research of Southeast Asia economies. Namrata holds a master degree in economics from Delhi School of Economics, Delhi. She also a charter holder of CFA Institute USA. So welcome, Namrata. Over to you.
Hi, good afternoon, everyone. So, budget is always an important day for us as a financial market participants or businesses or for households alike. And this is even the fact, despite the fact that now most of the indirect taxation reforms or changes happen outside the budget purview, which is by the GST Council. And you also hear certain key developments or reforms also happening outside the budget. Yet the fact that direct taxation is mostly altered is only altered within the budget realm, and coupled with the fact that this time the government came with the BJP government came with slightly weaker mandate in the general election. So all eyes were on the fact that would you see some tilt towards the rural support or the welfare spending. And finally, one thing which market was speculating, and we have seen a lot of action over there, was what will happen to the capital gains tax. We all were hearing that there will be measures to rationalize the capital gain tax structure, because in India, up until now, I mean, there is 1 year which get categorized as a long term, or 2 year or 3 year, and then there are asset classes which have a different long term, different short term. There are indexation benefits, no indexation benefits, and multiple of those aspects. There has been a significant move towards rationalization. So we will discuss that a bit. But now let us start with what had changed between the interim budget, which was a vote on account budget, and what has until now in the last 6 months. The first aspect is that when the government presents the interim budget, at that time they're only sitting with 10 months of data for FY24. You're still to receive and expend for the Feb and March month. So finally, when the entire statistics were available for FY24, government ended up realizing that in FY24 itself, they had budgeted an initially a 5.9% of fiscal deficit. During the revised estimate, they thought they will bring it down to 5.8%, but eventually, because your receipts were so strong, that you ended up clocking a 5.6% fiscal deficit. And even the second aspect was that you had received a sharp, the government had budgeted that RBI dividend in FY25 would most likely be around 83,000 crore, but it ended up getting 2.1 lakh crore in the month of May. So there was a clear 1.2 lakh crore of benefit. Apart from that, most of the PSUs also had declared their profits, so there was some idea and an understanding that even PSU dividend. So overall, on the dividend and profit transfer category, the non-tax revenue, we were quite sure that there would be gain of 1.5 lakh crore vis-a-vis what was budgeted in the interim budget. So this was very strong starting point. And the second starting point, which was very healthy, was government most likely ended the year FY24 with a healthy cash balance of 1.5 to 2 lakh crore. And because of that, because of the dividend and income, I mean, overall tax collection in the first 2 months were also healthy. Government had targeted an 11% tax growth, and if you see the gross tax collection for April and May, they were running closer to 15%, though 2 months don't make a trend. So, but it was an indication that as of now, there's nothing to worry about much about the taxation front. So, the fact of a good dividend transfer and a healthy cash balance had led market to speculate that perhaps you could see a reduction in FY25 fiscal deficit target 2 from a budgeted 5.1%. Market was speculating, could it be 5% or 4.9? And today, finally, we've got a 70 basis point consolidation to the tune of 4.9%. So what has changed? So why was there also an expectation on? So first, there was an expectation of sharper fiscal consolidation that had been met. Second, there was an expectation on your capital gains rationalization that has been met. Third was some expectation on the fact that you could probably see some welfare measures, some increase tilt towards the rural-oriented spending. But that has not come by, and even we weren't expecting that. And I will come to you in a bit that why weren't we expecting government to go, a central government budget to go more welfare-oriented. And why was there an expectation that rural spending or welfare spending would increase? It was because if you would see on the graph on top right hand side, the revenue expenditure, which is more or less, I mean, somewhat akin to the welfare spending as well, not exactly entirely, but maybe to an extent, you'd see that as a percentage of GDP or the allocation by the central government towards the rural-oriented schemes or subsidies or any of such things were reducing at the margin. So while the government was consolidating the fiscal deficit, it wasn't compromising on your capex, capital expenditure, but it was compromising on the revenue spending. So maybe people thought that now it's a coalition party, there will be pressure from the coalition governments of Andhra Pradesh and Bihar, or maybe political compulsions would necessitate that given that the consumption growth isn't as strong, maybe it would necessitate government to move a bit towards the revenue side. So finally, what has happened is you have seen your fiscal deficit consolidate by 70,000 crore. Your receipts have been jacked up by 1.2 lakh crore because government has kind of toned down the receipts from the other categories. Your total expenditure has gone up by 50,000 crore. Your capex target, the capex which is to happen from the budget, is left unchanged at 11.1 lakh crore. Some of the other expenditures, revex has been taken up by 50,000 crore. But if I look at overall rural-oriented schemes, they still languish in the rate of 8 to 10% growth, which was the trend which was also seen during the interim budget. That was on the bigger picture or the figure side. When it comes to fixed income side, the fiscal consolidation, how has it impacted the market borrowing? So government has left its GSEC calendar or GSEC supply unchanged, but for the short-term borrowings, it was previously anticipating that there would be a net increase in supply to the tune of 50,000 crore. Now the government is saying that there will be a net reduction in the T-bill supply to the tune of 50,000 crore. As of now, market hasn't reacted as much, perhaps because you already know the T-bill calendar for the second quarter, but it is likely to to lead to some sort of compression in the yields in the shorter end. And if you look at the yield curve feature of the Indian fixed income asset class, the yield curve is flat for the sovereigns, but it is highly inverted for the corporate bonds and CD space. So your CDs today are trading at 1 year CDs at 760, whereas the longer term paper are for the NBFC or any such. I mean, there is an yield curve inversion, the shorter term rates, because of the fact that your credit to deposit, the banks in India are seeing a faster credit growth as compared to the deposit growth. That is leading the banks to come and borrow in the CD market, and which is leading to jack up in the your short-term rates. And there is an expectation that with an improved liquidity in the coming months and with such kind of actions, perhaps short-term rates could ease. Now, coming to the equity market eyes, most importantly, they keep an eye on the taxation changes, and there the taxation changes have been very significant. In terms of capital gains tax, so the objective wasn't as much to shore up the collection. The objective was to rationalize. And in a bid to rationalize, some asset classes have gained, some asset classes have lost out. So, for example, the listed equities uh, is now, so first, what they have changed on the tenor side. So what they've said is the classification of long term and short term will stay unchanged for the equity oriented mutual fund and the listed stocks, as one greater than 1 year being long term and less than 1 year being short term. But for all the other asset classes like unlisted equities or gold ETF, silver ETF, any immovable property, movable properties, listed bonds and debentures, for all of these or any, I mean, other multi-asset equity fund, whatever be your past tenor of classifying as long term, now it is greater than 2 year is classified as long term and less than 2 year is classified as short term. And there isn't a change on the short-term capital gains. It is a change only for the listed and the equity-oriented mutual fund, which will now attract a higher short-term capital gain of 20% vis-a-vis 15% previously. But long-term, practically for most of the financial assets, it will be at 12.5% for the gain, and the indexation benefit has been done away with. Of course, for the equity and the equity-oriented mutual fund, the taxes will only be applicable now if your gains exceed 1.25 lakh vis-a-vis 1 lakh previously. And the date of applicability for most of these changes are from 23rd July, that is today. But for the gold and silver ETFs or the overseas, for some of them, it will be 1st April 2025. So this is one development which perhaps when the initial announcement was made, the equity market didn't take it as favorably. But like I said, different asset classes will see a different gain or loss. So for example, it is positive for gold ETF. You ask me for real estate. Real estate, it depends on how old is your asset. So if your asset real estate holding is, I mean, your property you purchased was in 1990s or something, perhaps with the indexation benefit, your income tax applicable long-term gains tax would have been slightly lower, but now it is at 12.5%. So different asset classes benefit in a different way. There had been government and SEBI had been concerned about the rising participation in the derivative markets, more so the participation of the retail investors. And I can show you one of the graph which tells me that there has been a sharp surge in the so for example, if you will see this graph, This is the graph which is from NSE Market Insight, Market Pulse, and you can see that the participation in it is at the notional value uh, from various participants have surged significantly. It used to be around 6.9 lakh crore. It's gone to 160,000 lakh crore. So that is the kind of increased participation on the notional value. Of course, this is, I'm not talking about the exact, the value that is put in, but on the notional terms. So there has been a surge in the participation, and there has been increased participation from the individuals category as well, which is what concerns the market, the SEBI as well as the government. So we had heard a plethora of tightening or the regulatory measures that were being thought by SEBI in the month of June as well. Now the government has marginally increased the STT on equity options and equity futures. For futures, it's gone up from 0.0125% to 0.02%. For the options, it's gone up from 0.0625% to 0.1%. Yeah, but apart from that, when I come to the marginal from the personal tax front, on the personal taxation front, again, during the speech, the FM cited that now 2/3 of the tax filings are happening in the new tax regime. They want to incentivize it, so they have further changed or tinkered these tax slabs. So the net idea is that they had themselves put out that they estimate that these changes would lead to an income tax loss of around 17,500 crore. But the changes that have happened in the capital gains front would lead to a gain on 30,000 crore. So on a net basis, there's a marginal improvement in the income tax. But like I said, the objective isn't to increase the income tax collection when it comes to capital gains, but more to rationalize the tax structure. And another feature of the Indian economy right now is you are seeing a sharp rise in the income tax collection. So if you will see, your income tax collection has, for the first time since FY18, income tax collection has surpassed the corporate tax collection. But is it unusual for India? We studied, when we looked at OECD countries, we figured out that this is the feature even for rest of the world on earth on a majority basis. For your personal income tax, including the capital gains, tend to be 2.5 times of the corporate tax collection. And in India, if I have to bring out the recent surge that is happening in so I was just looking at this data in FY23. The average income tax that was reported for the purpose of tax filing is roughly around 12.2 lakhs. And in FY24, that hadn't changed much. It was around 12.6 lakh. So it is, so whenever your tax slabs are getting changed, people are accordingly adjusting their reported income. So it isn't much of an individual reporting a higher income, which falls within the taxable bracket, but it is more so number of people who are filing the tax. So number of people who are filing the tax have jumped from some 3 crores in FY13 or 4 crores to around. So there has been a doubling of the ITR filers, and if 80% of the people used to file less than 5 lakhs in FY13, now it is just I mean, the proportion has reduced. But if your 8 crore people are filing the taxes, if you think there are 58 crore people who work in India, even if I strip out the agricultural workers, there are some 35 crores people who work in India, or 16 crore people who are within the regular wage bracket. They are the regular salaried people. So the tax returns or the number of people, the compliance still have more scope to improve. And right now, government isn't looking at any sort of significant rationalization in the taxes. But I think maybe few years down the line, where participation is not so much of a constraint, as in we are not worried about people are not paying taxes. So everybody is with the are filing. I mean, more or less, people, Indian population are filing the taxes. Once we get to that stage, perhaps that is the stage when government will start to think about the rationalization of the income tax structure more seriously. However, in the latest budget, they have said that they really want to significantly rationalize the income tax as well as the custom duty structure in India. Perhaps now I will stop to take questions if there are any.
Yeah. So yeah, thank you, Namrata. So thank you for sharing such a great insight. All the participants, I request all the participants, if you have any question, please write it in the chat box, and we'll take the question from there. So Namrata, a few things and few questions which are already there. So participants wanted to know, like, which all the like, if I'll talk about which all the industries wherein we can see the maximum like some
Diwakar,
movement.
your voice. Can you repeat your questions? There are some
So if I'll
issues with
talk about,
the.
yeah, Namrata, am I audible now?
The last line was clear. But I'm sorry, you will have to repeat your question.
Not an issue. So I'm asking, like, there were many things which were discussed there in the budget, and according to you, so participants are asking, like, which all the industry which you think will benefit from today's budget. So if you can put some light on the, like, in terms of which all the industry will get the benefit on this.
Sure. So I think my bad. I should have delved a bit on the expenditure front. So I can clearly see a lot of focus on the renewable energy front. So whether it was the rooftop solar or it was in the green energy space, there were multiple measures which were announced, and that would perhaps be the focus. Then you had seen some rationalization in the taxes for gold. So you've clearly seen those stocks doing a bit. I mean, they have already. I can see in terms of stock market movements, they've already factored in some of those gains. Apart from that, there's one more aspect which I think we should look at. So while we keep on talking about that the central government budget hasn't been that it hasn't been negative on the rural welfare schemes, but it hasn't been very strongly positive either. Though it did talk about the job creation, it did talk about creating the allocating money towards the skilling. But what I can see is that they are increasingly deploying the state budgets in order to meet the welfare needs. And this is not only true for the states which are non-BJP. This is true for the BJP and the non-BJP states alike. And I think there is a merit also because every state has a different need. Devising the welfare schemes at a pan-India level perhaps at times would lose out on the micro requirements of a particular state. For example, if you would see Rajasthan, Madhya Pradesh, Chhattisgarh, they are BJP ruled state, and even in Haryana, of late we've heard a lot of promises ahead of the election. And if I sum up in last 1 year, various measures that have happened, the expected annual outgo if these schemes were to be implemented in entirety could be more than 1% of GDP. So, given where your consumer stocks are in the expectations out of many of these, I mean, leave aside auto or maybe consumer durables, for many of these stocks, the expectations to start with are very muted. So, once you start to see these benefits kind of reap in, coupled with the fact that we're already seeing rural sentiments kind of improve, perhaps that is the time when you could start to see at the margin some benefit for the consumer oriented stocks. Yeah, so perhaps renewable energy and some focus at consumer, and then tax specific changes and those aspects benefiting a few sectors. Those are my key takeaway.
Okay. So there are many questions which are coming on the tax part, Namrata. So like if you can just show us the same slide again wherein you were discussing about tax. So there were many questions like what will be the
You
tax
mean the
on
capital gains
derivative?
tax, right?
Yeah. So
So,
what
do you want
changes?
me to? I think maybe we should just quickly, and we will put this out in our presentation. So I don't know if your clients get it, but this will be the part of our presentation which goes out today. So if you have to go through one by one, perhaps I guess that will answer a lot of questions. For the listed stocks, for example, the tenor for classifying long term stays unchanged, but there is an adverse increase in the short term and capital long term capital gain tax to 20% and 12.5%. Similar is the case for equity oriented mutual funds. For the unlisted equities, I think there is a positive development because the short term is unchanged, the tenor is unchanged, but now you have a 12.5% of gains. It used to be 20% with inflation indexation benefits. So, if you were invested in the unlisted equities in the last I mean, it will really depend on how long have you been holding these unlisted equities. So for, I mean, if you had been holding for less than 5 years, perhaps your net taxation would still come out to be a net tax gain for selling if you want to sell it now. For gold, again, it has been so actually for gold, yes, there is a change in the tenor from 3 year to 2 year, and in terms of long-term taxation, you will see practically all of them have seen that they were the ones with, except for the listed bonds and debentures, their existing long-term capital gain was 20% with inflation indexation benefits, except for listed bonds and debentures, which was without indexation benefit. That has gone to 12.5%. And just keep that a blanket rule in mind that whatever was your old tenor for classifying as long term, it's now changed to 2 years. So there has been a significant change in the gold, silver ETF and the gold fund and overseas equity mutual fund, because previously they were categorized as the debt assets. They were treated, their tax treatments were more like pure debt, which had no tenor benefits. So it was always taxed as per the applicable income tax rate. So that has changed for gold and silver ETF, though that will be applicable from 1st April 2025. Similar is the case for overseas equity and gold fund, though for that the tenor has changed to 2 years. There has similarly for multi-asset equity fund also, this will be applicable from 1st April 2025, but it will be, instead of 3 year, now 2 year is your long term, and there is a 12.5% of long-term capital gains tax. So I don't know, after this, if there's any question, please feel free to pour in.
So the question is like, this is effective from when? Like, what would be the period from where these rates will be effective?
So I have shown it that so it's different for different asset classes. For listed, I mean, for most of them, it is applicable from today. So even if you make any sale today, it is applicable. But for gold, silver ETF, for overseas equity mutual fund, gold fund, as well as for multi-asset, it is applicable from 1st April 2025. I would just like to give one disclaimer. So this is
Okay.
the
So,
understanding that hello, yeah, this is
yes.
the understanding that we have gathered after discussing with a few tax consultants and the tax experts. But you would very well appreciate that the 2 hours, this is to the best of our understanding. And I hope, I mean, I'm kind of sure that maybe 95% of it would be correct, but feel free to question or doubt it. And because it's a very short span of time to get absolute clarity on this.
Then I agree, Namrata. So even I would request all the participants kindly get in touch with your chartered accountant, because they are the one who can guide you like properly as per your requirement. So yes, we are giving you the information, but at the same time, kindly get in touch with your CA as well. So there was a discussion, Namrata, regarding corporate tax from 40% to 35%. So can you put some light on that as well?
Sorry, can you elaborate your question? 40% to 35% corporate tax.
So corporate tax for
See,
MNC from 40% to 35%.
so see, what I know about corporate tax in 2019, up until 2019, your peak rate was 35%. Now from 2019, your peak rate is 25%. Of course, if you are claiming any tax holidays, then I mean for law purposes, it is 45%. But practically, or everybody now falls. I mean, or for all practical purposes, the peak rate is 25%. And in fact, I was looking at the budget documents. They are saying that on an average, most industries are facing an effective taxation rate of around 22%. And then I guess what the budget statement that Nirmala Sitharaman made is that 50% of the corporate taxes are getting paid through simplified tax regime. So these were the few discussions on the corporate tax side. You will have to be a bit more specific as to what is it that you want to discuss.
Okay. I think we have covered most of the question, Namrata. So if there'll be any further question, if any participant would like to ask, please ask, and or we can close the call. So we'll wait for 1 more minute, Namrata. If there'll be any further question,
Sure.
we'll take it.
Yeah.
Yeah, Namrata. One more question is there, like what is the holding period of under construction property for it to be categorized for long term versus short term? Can we take this question, or
I don't have a, I mean, I don't know if the treatment for under construction property would be, but
not an issue,
see,
not an issue.
I mean, this is what I know. So, this is, I mean, this is, I'm quoting it verbatim from the budget documents. So I guess you guys should see the rate of long-term gains under long-term capital gains under provision of various sections of the Act is proposed to be 12.5% in respect of all category of assets. So this rate was earlier 10% for listed equity, units of equity-oriented fund, and the business trust, which are like InvITs and REITs. So now it will be 12.5%. Exemption for listed equity, business trust, and units of equity oriented has been increased from 1 lakh to 1.25 lakh. For the bonds and debentures, the rate of taxation was 20% without indexation. Now it will be reduced to 12.5%. For unlisted debentures, unlisted bonds, all of that, it will be at the applicable tax rate. And then with rate, then they're saying that with the rate rationalization to 12.5%, indexation to be removed for calculation of any long-term capital gains which is presently available for property, gold, and any other unlisted. So I guess my way to look at for the under construction was, if your, I mean, whatever was your existing guidance for the under construction, if it was from the date of possession or those aspects stay unchanged. I don't have a clue about it. I'm saying that the starting point perhaps stays unchanged, but the tenor, it is very clear that if it was 3 year to be classified as long term, everything they're saying blanket for all category of asset, it will now be 2 year. So for, I mean, changes in tenor, if you can see, for all listed, for all the holding period for unlisted, yeah. So for everything, they have brought it down to 2 years. So that would be my guiding thought process. But of course, you can clarify it with your CAs.
Okay. So Namrata will take one or two more questions. So one question is like, if I talk
Sure.
about some sectors like IT sector, infrastructure, banking, and pharma. So how the impact would be as per today's budget?
So I mean, my prima facie, my initial assessment is that it is broadly neutral for IT. Then I don't remember any significant adverse movement. Or I mean, for IT, for pharma, they are proposing that there would be reduction in the import duty for a lot of pharmaceutical products. If for infrastructure, even the economic survey kind of pointed out that, and this is something that we've been hearing for last couple of months, that even during the interim budget, that government now wants private sector participation to increase. For them to put in the money. For example, even for the road projects, up until now, the majority of projects were under the EPC mode, followed by the HAM mode. So they want increasingly the players with the good balance sheets to bid for the BOT assets, which will require greater fund and stake from the private players. For infrastructure, I mean, even if I have to go outside the budget, there was some moderation in the order inflow in the Q1 FY25, but that was widely anticipated because you don't get material order inflow just during the election time. But otherwise, from a broad macro perspective, the story for infrastructure orders stay robust. With regards to IT companies, you have to look beyond the budget. Very recently, the IT companies have, I mean, the market already had a very muted expectation in terms of the revenue growth trajectory for them, which had been taken. I mean, so for example, if they were expecting a 1 to 3% revenue growth, that revenue growth guidance has been increased from 3 to 4%. So you can say that the recent results have been a marginal upside surprise for the big IT players, and perhaps that is why you've seen a better performance, and the valuations for the IT companies were already at a comfortable levels, and that's why in the recent weeks you have seen some improvement. But does on the top the structural story for the IT sector, does it change? Perhaps they're not so much. They're still prone to the risks, growth risks that stay in the global economy, more so in the US. So IT, infrastructure, and pharma, those were your three questions, I guess. Have I missed out any?
Banking sector was the one.
So banking sector from a valuation perspective looks comfortable, though there are some issues on their ability to secure the deposit. So they are because the RBI is guiding them to either you increase the deposit or you bring your credit growth down. But I mean, actually, to be very honest, for the banking sector, I think there were some announcements in the budget, but I will have to go back to look at it. But apart from that, from the valuation perspective, the sector looks comfortable.
Okay, great. Done. So thank you, Namrata. Thank you for taking out the time, and we have covered most of the questions which participants were asking. So thank you for sharing such a great insight. And I would like to thank all the participants. They have taken out the time and joined us. So thank you, everyone. Have a great time.
Most welcome. Bye.